Let's face it, the economy is a bit like a roller coaster. It has its ups and downs, twists and turns. But just like a roller coaster, these movements aren't random. They follow patterns we call economic cycles. Understanding these cycles is essential for your financial well-being. It doesn't matter if you're a seasoned investor or just starting. Knowing where we are in the economic cycle can help you make smarter decisions. It's about knowing when to invest boldly and when to be more cautious. It's about riding the waves of economic change, not being wiped out by them. Are you ready to become an economic cycle expert? Let's dive in. Imagine the economy as a giant wheel, constantly turning through four distinct phases: expansion, peak, recession, and recovery. These phases are like the seasons of the year, each bringing its own unique set of circumstances and influencing the way businesses and individuals operate. Each phase has its own characteristics, its own set of opportunities and challenges. Understanding these phases can help businesses and individuals make better decisions, whether it's about investing, hiring, or saving. Expansion is the boom time. The economy grows, businesses flourish, and unemployment is low. During this phase, consumer confidence is high, and people are more willing to spend money on goods and services. People feel confident, spending money and investing freely. This increased spending leads to higher demand for products and services, which in turn encourages businesses to expand and hire more employees. It's a time of prosperity, but it doesn't last forever. As the economy continues to grow, it eventually reaches a point where it can no longer sustain such rapid expansion. Eventually, the expansion reaches its peak. This is the highest point of economic activity. At this stage, the economy is operating at full capacity, and any further growth becomes increasingly difficult. But beware, what goes up must come down. The peak is often followed by a period of decline, as the economy begins to slow down and enter a recession. After the peak comes the downturn, also known as a recession. This phase is characterized by a decrease in economic activity as businesses cut back on production and lay off workers. This is a period of economic contraction. Businesses struggle, unemployment rises, and people tighten their belts. Consumer confidence drops, leading to reduced spending and further economic decline. It can be a challenging time, but it's important to remember that recessions are a natural part of the economic cycle. They serve to correct imbalances in the economy and pave the way for future growth. Finally, after the recession comes the recovery. This phase marks the beginning of a new cycle of growth as the economy starts to heal and rebuild. This is when the economy starts to heal. Businesses slowly begin to hire again, and consumer confidence starts to return. People become more willing to spend money, which helps to stimulate economic activity. It's a time of cautious optimism as the economy slowly but surely begins to climb back up. The recovery phase can be slow and gradual, but it sets the stage for the next period of expansion and growth. Understanding the four phases of economic cycles can help us navigate the ups and downs of the economy. By recognizing the signs of each phase, we can make more informed decisions and better prepare for the future. Just like the seasons, the economic cycle is a natural and ongoing process. By staying informed and adaptable, we can thrive in any economic environment. Whether you're a business owner, an investor, or simply someone trying to manage your personal finances, understanding the economic cycle can provide valuable insights and help you make better choices. So the next time you hear about the economy being in a particular phase, remember that it's all part of a larger cycle. And with each turn of the wheel, new opportunities and challenges will arise, shaping the future of our economy. History is a powerful teacher, especially when it comes to economic cycles. By examining the past, we can gain valuable insights into the patterns and behaviors that shape our financial world. The Great Depression of the 1930s stands as a stark reminder of how severe economic downturns can be. It was a time when the global economy came to a grinding halt, and the effects were felt by millions. It was a period of widespread hardship, with unemployment soaring to unprecedented levels. Families were torn apart, and communities struggled to survive. The images of long unemployment lines and desperate faces are etched into our collective memory. The 2008 financial crisis, while not as severe as the Great Depression, also left a lasting impact. It was a stark reminder that even in modern times, our financial systems are vulnerable to collapse. Triggered by a collapse in the housing market, it led to a global recession and highlighted the interconnectedness of the global economy. The ripple effects were felt worldwide. from foreclosed homes to empty office buildings, and the economic pain was widespread. These historical examples teach us the importance of understanding the causes and consequences of economic cycles. By delving into the details of these crises, we can uncover the underlying factors that led to such widespread economic turmoil. By studying the past, we can better prepare for the future. We can identify the warning signs that precede economic downturns and take proactive measures to mitigate their impact. This knowledge empowers us to make more informed decisions and build more resilient financial systems. We can learn to recognize warning signs and make more informed decisions. For instance, understanding the role of speculative bubbles, excessive leverage, and regulatory failures can help us avoid repeating the same mistakes. Remember, history doesn't repeat itself, but it often rhymes. By drawing parallels between past and present, we can gain a deeper understanding of the economic forces at play and navigate the complexities of our financial world with greater confidence. While every economic cycle is unique, they often share common threads. These threads can be seen in the way economies expand and contract over time, influenced by a variety of factors including consumer behavior, government policies, and global events. Understanding these patterns can provide valuable insights into the future. By studying past cycles, we can start to recognize patterns in how the economy behaves. Historical data offers a treasure trove of information, revealing how different sectors respond to various stimuli. For instance, the stock market often reacts to changes in interest rates, while consumer spending might be influenced by employment rates. For example, periods of rapid economic expansion are often followed by periods of correction. During these times, businesses may overextend themselves, leading to a surge in production and investment. However, this rapid growth can create imbalances that need to be corrected, resulting in a slowdown or even a recession. This is because unsustainable growth can lead to imbalances, such as asset bubbles or excessive debt. When these bubbles burst, the economy can experience significant downturns. The housing market crash of 2008 is a prime example, where excessive lending and speculative investments led to a severe financial crisis. Similarly, recessions are often preceded by periods of rising inflation or excessive speculation. When prices rise too quickly, it can erode purchasing power and lead to reduced consumer spending. Speculative bubbles, on the other hand, can create a false sense of security, encouraging risky investments that may not be sustainable in the long run. By recognizing these patterns, we can better anticipate potential turning points in the economy. This knowledge allows investors to adjust their portfolios, businesses to plan for future growth, and policymakers to implement measures that can mitigate the impact of economic downturns. This doesn't mean we can predict the future with certainty. The economy is influenced by countless variables, many of which are unpredictable. However, understanding the cyclical nature of economic activity can provide a framework for making more informed decisions. However, by understanding the cyclical nature of the economy, we can make more informed decisions about our investments, our careers, and our overall financial well-being. For instance, during periods of economic expansion, it might be wise to invest in growth-oriented assets, while during downturns, more conservative investments might be preferable. Remember, knowledge is power, especially when it comes to navigating the ups and downs of the economic roller coaster. By staying informed and understanding the underlying patterns, we can better prepare for the future, making strategic decisions that enhance our financial stability and growth. Whether you're an investor, a business owner, or simply someone looking to secure your financial future, recognizing these economic patterns is a crucial step towards achieving your goals. The Great Depression and the 2008 financial crisis serve as stark reminders of the importance of understanding economic cycles. These events, though decades apart, share striking similarities. Both were preceded by periods of excessive borrowing and speculation. In the 1920s, rampant speculation in the stock market led to an unsustainable bubble. When the bubble burst, it triggered a chain reaction of bank failures and economic collapse. Similarly, the 2008 crisis stemmed from a housing bubble fueled by subprime mortgages. These mortgages were bundled into complex financial products and sold to investors worldwide. When the housing market crashed, the financial system teetered on the brink. Examining these historical parallels reveals a recurring theme. Financial crises often arise from a disconnect between asset prices and their underlying value. By studying these events, we can learn to identify similar patterns in the making and take steps to mitigate their impact. Over-leveraging and asset bubbles are two key indicators of an impending economic downturn. Over-leveraging occurs when individuals, businesses, or governments take on too much debt. This excessive debt can create a fragile financial system. When asset prices rise rapidly and become detached from their underlying value, asset bubbles form. These bubbles are often fueled by speculation and herd mentality. Investors, caught up in the euphoria, ignore the fundamentals and drive prices to unsustainable levels. The dot-com bubble of the late 1990s is a prime example. Investors poured money into internet companies with inflated valuations and little to no earnings. When the bubble burst, many of these companies went bankrupt, and investors lost billions. Recognizing these warning signs is crucial for making sound financial decisions. By exercising caution and avoiding excessive risk, we can protect ourselves from the worst effects of economic downturns. Economic cycles are a natural part of the financial system. Just as the seasons change, so too does the economy. Attempting to fight or deny these cycles is futile. Instead, we must accept their inevitability and adapt our strategies accordingly. Understanding that periods of growth will inevitably be followed by periods of contraction allows us to make more informed decisions. During periods of expansion, it's essential to build a strong financial foundation. This includes saving for the future, diversifying investments, and avoiding excessive debt. When contraction occurs, we can draw on our reserves, adjust our spending, and weather the storm. By accepting the cyclical nature of the economy, we can avoid making emotional decisions and instead focus on long-term financial well-being. Section 5. Weathering the storm. The power of strategic diversification. Strategic diversification is essential for mitigating risk and ensuring stability in a volatile market. Diversification involves spreading your investments across different asset classes, such as stocks, bonds, real estate, and commodities. This strategy helps to cushion the blow when one asset class performs poorly, as others may perform well. Imagine your investments as a fleet of ships sailing in different directions. If one ship encounters rough seas, the others may sail smoothly, ensuring the overall fleet remains stable. Similarly, a well-diversified portfolio can withstand market fluctuations and deliver consistent returns over time. By diversifying your investments, you create a buffer against the unexpected and protect your financial future. Section 6. The debt cycle. A powerful force shaping our economic fate. The debt cycle plays a crucial role in shaping economic cycles. When interest rates are low, borrowing becomes cheaper, leading to increased spending and economic growth. This growth, however, often comes at the cost of accumulating debt. As debt levels rise, so too does the risk of a credit crunch. A credit crunch occurs when lenders become hesitant to lend money, fearing borrowers may default on their obligations. This tightening of credit can lead to a slowdown in economic activity, potentially triggering a recession. Understanding the debt cycle is vital for policymakers and investors alike. Policymakers must carefully manage interest rates and government spending to avoid creating unsustainable debt levels. Investors, on the other hand, can use their understanding of the debt cycle to anticipate potential risks and adjust their investment strategies accordingly. Section 7. Case Study. The Dutch Tulip Mania and the Dot-Com Bubble. The Dutch Tulip Mania and the Dot-Com Bubble are classic examples of asset bubbles and the dangers of speculative investing. In the 1630s, tulip bulbs became a highly sought-after commodity in the Netherlands. Prices soared to exorbitant levels as people speculated on their future value. At the peak of the mania, a single tulip bulb could be traded for more than the cost of a house. Similarly, the dot-com bubble of the late 1990s saw investors pouring money into internet companies with little regard for their underlying fundamentals. In both cases, the bubbles eventually burst, leaving investors who bought at the peak with significant losses. These historical events serve as cautionary tales about the importance of rational investing and the dangers of getting caught up in market hype. Section 8. Dalio's Principles Navigating the Economic Landscape. Ray Dalio, a renowned investor and hedge fund manager, has developed a set of principles for navigating the complexities of economic cycles. Dalio emphasizes the importance of understanding history, recognizing patterns, and adapting to changing circumstances. He advocates for a data-driven approach to investing, emphasizing the need to analyze economic indicators and make informed decisions based on evidence. One of Dalio's key principles is the concept of radical transparency, which encourages open communication and the sharing of diverse perspectives. He believes that by embracing diverse viewpoints and challenging assumptions, we can make better decisions and avoid costly mistakes. Dalio's principles provide a valuable framework for understanding economic cycles and navigating the financial markets with greater confidence. Section 9. The importance of education. Empowering yourself with knowledge. In the face of complex economic cycles, knowledge is power. By investing in our financial education, we empower ourselves to make informed decisions and achieve our financial goals. Understanding basic economic concepts such as inflation, interest rates, and market cycles is crucial for making sound financial decisions. Numerous resources are available to enhance our economic literacy. Books, articles, podcasts, and online courses provide valuable insights into the workings of the economy and the principles of investing. By dedicating time and effort to expanding our financial knowledge, we gain the confidence to navigate the complexities of the market and make informed decisions that align with our long-term goals. Section 10. Taking action. Applying historical insights to your financial life. Understanding economic cycles is not enough. We must take action and apply this knowledge to our financial lives. Begin by assessing your current financial situation. Evaluate your income, expenses, assets, and debts. Develop a budget and a savings plan that aligns with your financial goals. Next, consider your investment strategy. Diversify your portfolio across different asset classes to mitigate risk. Consider your risk tolerance and invest accordingly. Finally, stay informed about economic trends and adjust your strategy as needed. By taking a proactive approach to managing our finances, we can navigate economic cycles with greater confidence and achieve our long-term financial objectives. Section 11. Conclusion. Embracing history for a more resilient future. History has much to teach us about the cyclical nature of the economy. By studying past economic cycles, we gain valuable insights into the present and the future. Recognizing patterns of over-leveraging, asset bubbles, and debt cycles allows us to anticipate potential risks and adapt our strategies accordingly. Strategic diversification, a data-driven approach, and a commitment to lifelong financial education are essential for navigating the complexities of the market. By embracing the lessons of history, we can build a more resilient financial future for ourselves and generations to come. Remember to subscribe to this channel for more insightful content on economics, finance, and history. Share this video with your friends and family and leave a comment below sharing your thoughts on the importance of learning from historical economic patterns. If you'd like to support our work, consider becoming a Patreon or checking out our merchandise. Together, let's embrace the wisdom of the past to create a more prosperous future.